Welcome back, everybody. Happy Halloween. This is Michael Burke with NinjaTrader. In this segment, we've got a new guest with us today. First appearance, probably one of many to come. Chuck Fulkerson, nice to see you.
What's going on, Mr. Mike?
You know, we are at it every day here on NinjaTrader Live, and this is a great place to kind of showcase those people who are really, influencers in this market. You're kind of a renaissance man for a futures trader. You cover a lot of different areas. You have a lot of experience. You've managed a huge team of educators in the past, so it's great to have you here. What are you working on now?
I'm staying busy, man. Markets are great right now. There's a lot going on. I actually just had a great time listening to that talk about harmonics a few minutes ago, and that was really cool because that's not something I always do, and I really love hearing different things. Like, I'm still, we're educating as many people that want to learn because there's more people now, I think, that want to learn how to take advantage of what the markets provide than have in my 20 years of doing this. And so, we're working with individual traders and investors, kind of teaching them, showing them how to do it, and really just being dad. That's what I do more than anything.
The thing is that nowadays, more than ever, there's more noise out there, and there's a lot of hype, and there's a lot of hyperbole, and what ends up happening is that doesn't work for people for the most part. And I think what you do, kind of gets them grounded. You have a more kind of strategic approach for people starting out trading. Maybe talk a little bit about your philosophy, about someone just starting out, maybe a little bit about your trading, your strategic approach, just so that someone who's getting started, they kind of get a good feel for where they should be at.
Yeah, what's funny is I didn't grow up on Wall Street. I don't have a degree in finance. I come from a background of learning and getting around really good traders. And what I learned more than anything is that the simple truth, the only truth in a market is price. Price is the only truth. And when we see that, when we know that price is the only truth, my job is to go find where there are more buy orders than sell orders, and where there are more sell orders than buy orders, sitting there waiting to get filled. Because the thing that I believe is that the professional institutions are the ones that move the markets. They've got the money to do so, but they can't walk without leaving footprints. And so what we really try to do is focus on, how do I find the footprints left by the giants, and trade those areas that are retracements, and then also understand that it's really about order imbalance. So everything is all about order imbalance. If there's absolutely no buyers at a price point, price has to fall, right? And if there's no sellers, price has to rise. And so that's what we ultimately are looking for. And there's various ways to do that, but really it comes down to the imbalance of buy orders and sell orders. And what I love is, like, whether it's Fibonacci's or moving averages or harmonics or whatever, I don't care why people are buying or selling. I just care that they are.
Yeah, that's an interesting point. So would you categorize that philosophy as counter trending trading? In other words, you're looking for the market to come up and counter trend, or are you looking for the market to come up and maybe continue? What is the...
I'm a big believer in the concept of tides and waves, right? You ever seen the movie Castaway with Tom Hanks?
Sure.
Right. So there's in Castaway with Tom Hanks. I don't want a spoiler alert, but it's a 10-year-old movie. So
I don't think that's possible.
But in that movie, he tries to get off the island. And the first time he does, he puts together a raft, and he puts that raft in the water. And as he puts it in the water, he puts it out, and it just gets destroyed because he put it out while the tide was coming in. Right. So later on, he remakes the raft and he puts it in while the tide is going out. Well, I still have to wait for a wave to come in, right? So yes, it's counter trend, but it's counter trend on the smallest of time frames. And so if the whole market's telling me to be a buyer on maybe the 1-hour chart, I'm going to look for the wave on maybe the 15-minute chart to come down into an area where I believe that there's some buy orders. Or if the trend on a 15-minute chart is going up, I'll wait for it to pull back on a 5, right? If I'm looking for a reversal setup. But I'm going to go with the trend if I'm looking for a breakout setup. So it's still the same idea of buyers and sellers, but if I'm going, I typically want to go with the tide if possible, and then not have a bias on the market. Like people say, well, where do you think the market's going? My correct answer is I don't care. My job isn't to predict, it's to react faster than everybody else.
Yeah, and it's funny that that philosophy is very much Jim and Tom and my philosophy as well. Very often, we want the market to prove to us that it's going in our direction.
Mm-hmm.
I don't want to pick a point where I think the market's going to turn. I want to pick a point where I think that the market at that point is an inflection point, and then prove to me which way you're going.
Yeah, and in big picture market turns, that means I'm going to sometimes get in a little too early, and then I'll get right back out. Like, I'm okay being wrong. I'm married. I've been married for 20 years. I'm used to being wrong, Mike. And so I'm okay if I'm wrong, but I want to be wrong the right way. And when I'm wrong, I'm going to be wrong a little bit. And so like for my big picture kind of larger wealth accounts, I'm willing to get back in too early, but I'm not willing to get out too late.
I see. So are you saying that you limit the heat that you take on a trade?
Yeah.
And so if it doesn't play out, then I'm willing to get out and take a loss, and then I'll wait for the next setup.
Yeah, that's exactly right. I am definitely willing, because I think too often we get tied into trying to be right all the time. And I want to go with the overall trend direction. But when the trend changes direction, I've got to change my bias. And that sometimes it means I'm going to take a few small hits. But I'm looking for those quality reward to risk setups so that I've got a minimal risk when I'm wrong, and I can get those larger gains when I'm right.
Talk a little bit about this is a kind of a combination question, because it ties in a little bit of account risk management with trade risk management, and that is what kind of trade sizing are you looking at when you get into a trade? Is this an account level kind of thing? Are you looking to scale in and scale out? What is your philosophy there?
So for me, and it's so unique for everybody, because there's this people say, well, you never want to lose more than 2% in a trade, in any given trade. Well, what if I've got a $2 million account and I'm trading on a 5-minute chart? I'm not going to risk 2%, right? And so it's very unique for the individual. I don't love when people say, well, blanket rule, never risk more than 2% of your account in any one trade. What I do is I say, okay, here's the total amount of capital that I have. This amount is allocated towards day trading, short-term futures. This amount is allocated towards swing trading of futures and maybe options positions. And then over here is the wealth side. And so the smaller the account, the larger I'm willing to risk percentage-wise of that portfolio. Now, once I get into a position, if it starts going my direction, like what I will do is I'll use a probability score essentially on the quality of the level. And if I get into a level and the level says, you know what, on my scoring now, we look at how did it leave the level? How much time did it spend at the level? What was the setup? What time was the level created? Like, I don't want levels that are formed at 7 p.m. Those are basically useless, but formed right at the European market open, boy, those are some of my absolute favorites, right? So that increases the probability. The higher the probability, the more likely I am to add to the position when it starts going my way. And I'm typically a big believer in, at a 2-to-1 reward to risk, I'm moving my stop to break even, and then I'll decide whether or not I'm going to add more to the position.
Interesting. And when you add more to that position, do you typically exit that all at the same time, or will you scale out of that as well?
Scaling out, for sure, scaling out. I'm a big believer, and even if you want to scale out, let's say you get in with 10 contracts. If I'm wrong, I'm out on all 10. But if I'm right, sure, I'm a big believer in, maybe you do 60, 20, 20, right? Get out of 60%, then you get out of the next 20, then get out of the next 20. And scaling out when I'm right, but completely getting out when I'm wrong.
Yeah, I totally agree with that. A lot of times new traders, they get in at this price, it goes against them. They say, well, I loved it at that price, I love it more at this price. And that's what gets people in trouble.
I got to tell you, Mike, I think that this concept of dollar cost averaging hurts the average investor when they want to become a trader, right? Because as a dollar cost averaging works until it doesn't, right? I mean, dollar cost averaging of stocks that I grew up in Pittsburgh, right? So drinking town with a football problem, but US Steel was the be all and end all. Well, if you dollar cost average US Steel from the 90s to today, you're in trouble. If you dollar cost average Alcoa from 2000 until today, you're in trouble. It's like, stocks aren't always going to be back. And so, but a lot of times people are used to hearing that dollar cost averaging and they take it to their trading. And that's not always a great idea because the market can stay irrational longer than you can stay solvent.
Well, especially with the concept of margin and the leverage that you get in the futures market, it works against you, not twofold, but fourfold.
Absolutely.
When you're trying to get out of that, and I agree with you. It's much better just take that loss. It's part of the game, and you look for that next great opportunity.
Yep. I'm huge on that. I'm willing to be wrong. That's you have to be willing to be wrong.
Yeah, that makes sense. One of the things that we wanted to talk about a little bit today is this concept of being a more strategic trader. So a lot of traders start out very discretionary, and they want to move to be more disciplined. How do you see that transition from discretionary to strategic? What are the kind of things that people have to do to get there?
Well, I think the first thing it starts with is, do you have a plan? Right? Do you have a written business plan, or like how would you outline what your business plan is and what your structure is? And I think that's the first step. Is I think a lot of people don't have a written plan of, this is my rules, these are my guidelines, right? Like, I know if it gets to a 2-to-1 risk to reward ratio, I'm going to move it to break even. I know that if it doesn't move my way within 6 candles, we move our stop to break even or we close the position. Like very, 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 very strict rules around there. And then I use a lot of things around formulas to calculate the probability of a level to see, is this one going to work, to tell me whether or not I should take it. And then what's funny is that if all the math says, yes, you should take it, I have to take it. Right? Because the probability says it. And so what I want to do, I think for most traders, the hardest thing is to remove their emotion and their gut early in the process. Because it's a little bit of an art and a science, there's no question, but I've got to utilize the probability metrics that I can create from finding the high quality zones.
I'd really like to explore that more with you. So the next time we're on, we can look at some charts and you can kind of talk through those concepts. I love that. The other thing that I wanted to talk a little bit about, because as you know, in my strategic plan, I use time also as a criteria. If I'm in a trade too long, or the market is just meandering sideways, the farther I get away from my entry, the less confidence I have in that trade, because the reason I got in is no longer valid anymore. The market just didn't do what I thought. And I was just going to wonder if that's something that you look at.
Oh, huge. So and I will tell you, this is one of the things that I think a lot of the students that I've worked with and the investors that we've worked with, they've fallen in love with this concept of the 6 candle rule. And the 6 candle rule, what it tells me is, no matter what time frame that I enter the trade, if my entry was on a 15-minute chart, I give it 6 15-minute candles to start moving my direction. If it hasn't moved my direction in 6 15-minute candles, if I'm at a little bit of a profit, I'll move my stop to break even. If I'm below a break even, I'm just closing the trade, even if it hasn't hit my stop. Let's say I'm swing trading and I use the daily chart, I'll give it 6 daily candles, right? If my analyzation got me on an hourly chart, I'll use 6 hourly candles. But the point is, it's called the 6 candle rule. Because my belief is, if I see an area where I believe there's a lot of buy orders, right? Maybe there's an area where there's a lot of buy orders. Maybe there's some confluence. Maybe there is a moving average, and it's a Fibonacci retracement, and it's an area where there's been some consolidation in the past. What I want is an area where a bunch of traders are deciding that's where I'm going to buy, right? And I don't care why, I just care that they are.
I love that concept.
Yeah. And if I get in and I'm not right, well, it's not going to bounce. It's going to kind of meander. So if I'm going to be wrong, I'm going to be wrong quickly and get out of that thing.
That's a great concept. I've never heard that before, but I am now going to incorporate that into my meandering time. I love that. Six bars, regardless of what the interval is.
People say, well, Chuck, how did you get to 6 bars? Easy. 5 was not enough and 7 was too many.
That is a really great concept. I love that. Let's talk a little bit about new traders. So some of the things that new traders get into trouble with is over trading. Mm-hmm. They think they can handle more than a couple of trades at a time. And so I want you to talk a little bit about how you feel about that. And the other thing is that a lot of new traders that come into this are people who have been successful in life, right? They have money to trade. They want to have a different lifestyle. They want to supplement their future. So they're super smart people, and they think that this is an easy way to continue that income stream. And very often they struggle or they fail because they don't put in the work.
Yeah. Yeah. There's no substitute for time. There is no substitute for time. And so I think that when we look at new traders, a couple things that I find. First of all, they have to be willing to take risk. If they're not willing to take enough risk, then they're not going to be successful. And when you talk about over trading, I think over trading means that they feel like they have to trade. And they feel like they've got to trade today. Like, I'm a trader, I have to find a trade. No, you don't. There's no book that says you have to find a trade today. And so if the market's going to give me a setup, I'm going to take it. If it's not, don't take it. Discretion is the better part of valor, I see on a regular basis when it comes to trading. And as far as people that have been successful in life, you know, I can't, and I run into this a lot when I'm talking to people that, you know, hey, I'm going to try to figure this out on my own. I'm going to watch some YouTube videos. I'm going to go practice. Listen, I could watch all the YouTube videos in the world. You still wouldn't want to drive on my bridge if I tried to be an engineer, right? I can watch every YouTube video about engineering out there, and you're not going to want to drive on my bridge or go in my building. You're going to want somebody who has gone through some sort of an orientation, some sort of a school, some sort of an apprenticeship. And so, you know, find a mentor, find somebody who's already successful and lean on them. Listen to what they're saying. I love what you guys do on this because you guys know the markets. You're bringing it every day. Like, that live market environment, so important. And oftentimes people think that they can just not use that and they can figure it out on their own. And I would say that's because it's a skill, right? And right. The way we learn any skill, I teach this in all my classes. The way we learn any skill, there's a 4-step method to learning a skill. Unconscious incompetence. I don't know what I don't know, right? Conscious incompetence. I know that there's more I need to know and I don't know it. Conscious competence means I can do it, but I have to think about it. And then unconscious competence. That's the way we learn every skill as a human being, whether it's swinging a golf club, driving a car, tying a shoe, or trading the futures market. And so the only way to get from conscious incompetence to conscious competence is education, right? Learning, how do I do it? What do I do? The only way to get from conscious competence to unconscious competence is repetition and continually doing it over and over again. And so, you know, it takes time. And so professionals, people that have had success in their other areas of their life, they've got to be willing to put in the time and the energy.
It's funny. I love the engineer and the bridge analogy. I used to use brain surgery as, you know, would you want me to do your brain surgery if I've just watched a bunch of YouTube videos? You probably wouldn't. And the other thing, and you make a great point about getting to that unconscious, is that you need the muscle memory of placing trades. The simulator is great for that. A simulated environment is great. A lot of people, like you said, they open an account with dollars and now it's burning a hole in their pocket. They want to get in 100%. The game. And the other problem is that they want to trade the maximum amount that they can trade safely, like this 1% or 2% that you talked about, but they haven't done it yet. They should be trading 1 unit or 2 units of the micros before they ever get further along.
I'm a big believer, Mike. I don't care if you come to me with a $10,000 account or a $10 million account. I'm going to tell you the same thing. Do 50 trades on a simulator, 50, in and out. If you're profitable, now I do 50 trades on 1 micro. At the end of those 50 trades, if I'm profitable, now I can move up to a couple of micro contracts, right? And I need to have done my number is you want to be doing 50 to 100 trades before you ever move to a full contract. Now, once you move to a full contract, you do 50 more trades at 1, and then you move to 2. And then you do 50 more trades at 2 before you move to 3. And so basically the idea is that if I'm going to scale up, I'm going to scale up with experience each time. I see most traders falter when they have early success with one contract and then they move to 5. I think that's a recipe for disaster. So, stepping up little tiny bits. And when you do that, the absolute hardest step you'll ever make is going from one contract to 2, because it's 100% more risk. It's 100% more return. It's 100% more nervousness. But when you go from 2 to 3, it's only 50% more. When you go from 3 to 4, it's 33% more. So each step gets smaller when you scale. And I'm a big believer in 50 trades. If you're profitable, move up. If you're not, go back to the last level where you were profitable.
Yeah, that makes sense. And the other thing I would add to that is that, traders need to really watch their emotions as they move up, because if you've had success at that lower level and now you struggle at this next level, the first inclination is I'm good at this. I'm going to double up again, or I'm going to chase losers again. And you end up blowing out that level and having to move back down, or even worse, you end up much worse off than you should have been.
Yeah. And people can make a living, and I've seen it. People make a living in the futures markets trading 3 to 4 ES contracts. I have a student that all she trades essentially is the ES and the NQ. That's it. She's just that's what she does. Trades the ES and the NQ, and she's really good at it. I have other students that try to trade everything on the planet, and I'm not saying which one is right, but I'm a big believer in, if you're going to start trading futures as a beginner, you use the big 4. And I call the big 4 the S&P, the NASDAQ, gold, and crude oil. All of those have micros. All of those are readily accessible. All of those are things that are not like, I mean, trading wheat futures, yes, there's value in it, no question, but it's esoteric to me. Like, it's not something I'm going to do. But the S&P, the NASDAQ, gold, and crude oil, that's something everybody can touch. You can start with a micro, and then you can move from there.
Interesting. We've got a couple of minutes left. I don't want to put you on the spot, but I'm going to put you on the spot here.
I'm good with that.
And that is, we're heading into the end of the year. Seasonality is usually pretty good in November, first part of December. Do you have a bias? Do you think that the political environment, the FOMC is cutting rates? Do you have a longer term bias here going into the end of the year and next year? Historically,
the fact that the FOMC cut rates is not bullish for the market, right? It's not. And if you go back and look, I think that as we look at this, I would not be surprised if 5 years from now, people call this the AI bubble. I wouldn't be surprised if 5 years from now, people call this the AI bubble. And if you go back and look at the last 3 or 4 times that the Fed has cut the interest rate, from the first day they cut the rate until the market bottom cycle, they were all down. I think the S&P averaged about a 48% decline. And the NASDAQ was much higher than that, like 57, because you got to count the 2,080% correction. You average those up, it's about a 50% drop. Do I think the markets are going to drop 50%? It could. That being said, my job is to not predict it, it's to react. And so right now, correct, I'm still very bullish. And I'm going to continue to be bullish until the market tells me not to be bullish. I do believe that we're going to see a very volatile post-election evening. I will tell you, if you've never traded futures and you think you're going to trade futures on election night, don't do that. That's a terrible idea.
That's a terrible idea.
But I do know people who've already said, hey, you think I could just place with some micros? No, don't. And I wouldn't be surprised if you go back and look at 2016 and 2020, in both cases, after the election, we saw the markets rally back up. And so I think that we will see a little bit of that, some seasonality built in, but I do believe it's long-term. I'm a bit more bearish long-term, mostly because I think we're a little overbought anyway.
Yeah, that makes perfect sense. Chuck, we're just about out of time. This has been really fun and great information. We'll have you back on and we'll look at some charts and you can talk a little bit more about the tools that you look at. But right now, how can people find you? What are you doing? How can people get in touch with you?
Yeah, I mean, there's some contact info at our website, which TradersArmy.com, or Main Stage Capital Group for those for some investors in that area. Find me on LinkedIn. Usually, LinkedIn's a great place that I talk to a lot of people on LinkedIn. I used to be a lot more active on Twitter and YouTube, but I'm mostly LinkedIn at these point nowadays.
That's perfect. Thanks so much for being with us. Happy Halloween, and we'll have you back real soon.
Thanks for having me.
following presentation is for educational purposes only. All the symbols, trading ideas, and market commentary are for educational and demonstrational purposes only and are not recommendations or trading advice. Live sample trading occurs in a simulated environment. Past performance may not be indicative of future results. All the information and content presented is provided by NinjaTrader LLC, and the opinions expressed by all third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involves substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.